you can. Again, thank you for coming today. This is part of our monthly series of educational webinars that Summit Financial Advisors puts on. Every month it's a different topic. And we like to bring topics that pertain to retirement. And then we also like to bring in guest speakers sometimes that can help share different information that maybe we don't specialize in. Again, so today the topic is how to provide for your surviving spouse in retirement. My name is Glenelle Jordan. I'm here. We also have Elsa Siegel. She is our financial consultant in Maui. She's here today. She'll be speaking. We have Kelly Tom, my partner here on Oahu. And we also have Doug Slagle here, also our partner here on Oahu. One thing I want to show really fast is that if you want to find out about our webinars in the future, you can visit our website. And our YouTube. So if you go to YouTube, Summit Financial Advisors, you'll find all of our videos. We have educational videos. We also have our previous live webinars. And then on our website, can you guys see the website?
Yeah, it's loading.
Okay.
Yep.
If you go to our website and you click on workshops, you'll be able to see our workshops that we've done in the past and that we're doing in the future. So next month on December 8th, which is a Tuesday, from 11:30 to 12:15, usually we talk about strategies for people that are approaching retirement, but we want to do something special end of the year. So we're doing strategies for young people. So what you should be doing in your 20s and 30s, tax saving tips and investing strategies. So this would be really good if maybe this is not you, but if you know somebody, a young person that you think this would be beneficial for, please forward it to them and have them register for it. And so once you register, the Zoom information will be sent to you. Okay, back to our presentation. So I'll start off today's presentation. We'll go for 45 minutes. If anybody has any questions, there's a chat box. So please ask your questions in the chat box. Kelly and I will be monitoring it, and we'll just interrupt each other if any questions come up, and we'll try to answer it for you guys. And then at the end of the presentation, there's just a couple of questions. So if you could answer those, like what other topics you'd like to learn about, as well as if you want to talk about your specific situation, you could put that in the poll at the end of the presentation. So the reason we talk about this topic, providing for a surviving spouse, is because a lot of the time when we meet with clients, there'll be one spouse that maybe has the bulk of the retirement assets, the bulk of the retirement income, maybe the pension. And we definitely want to do retirement planning for the family unit, but we have to be cognizant of what would happen if that spouse with majority of the assets passed away. How would the surviving spouse fare? And it's important to realize that a lot of things can change when that happens. And the retirement landscape on its own is shifting dramatically and has been over the past 10 to 15 years. Social Security and individual savings alone aren't always enough. So we have to be creative and be forward thinking in planning for our retirement and our spouses. For widows and widowers, it can be a very scary situation because the amount of money that you may be used to receiving in retirement can go down drastically. The statistics say that widows will need about 80% of a couple's income, but most widows are only going to have about 62% of an income of their previous income. So that's something that we can tackle ahead of time. My favorite motto is to hope for the best, but plan for the worst. So changes in just the retirement landscape in general over the past several decades is defined benefit plans, aka pension plans, are fading away rapidly. It used to be that anybody could have Most people, if you work for a company or a government entity, you'd have a pension plan, and it represented a significant amount of your pre-retirement income. I remember my grandma would always tell me to get a good job, stay with that company, and they will take care of you in retirement. I'll never forget when she told me that. And that is obviously changing. Most companies have completely eliminated their pensions plans, and some are phasing it out drastically. Increased longevity. So we are living so much longer than we previously were before. So we need to plan for sometimes 2, 3, 4 decades of retirement, sometimes just as long as we had in our working years. There are changes to Social Security, and there will be future changes to Social Security. Kelly will talk about that. Because it is an underfunded government program. And so we can expect to see reductions in some way, shape, or form there. And then rising healthcare costs that are also due to the fact that people are living longer lifespans. So taking that into consideration for not only the first spouse, but also the surviving spouse too. So surviving spouses need to prepare for the change coming their way should they become a widower. My grandmother's now 94. My grandfather passed away when he was 81. And interestingly enough, my grandfather, he was the healthy one. He was the one who was in shape, who played golf every day, much more fit than my grandma. And yet now my grandma has outlived him by almost 15 years, and she never worked a day in her life. So she really depended upon what he had set up for her and making it last for her as long as she may live. And she's still going strong. So they need to prepare for the change in Social Security benefits that will happen, possibly reduced pension benefits depending upon your election, reduced retirement account balances because those have been going down over time. Taxes could increase because you went from a joint income to single income tax returns. Medicare premiums could rise depending upon what income bracket you fall in. That's how Medicare premiums are decided. Increased withdrawal rate. We'll talk about required minimum distributions, how those go up every year. And then longevity risk. So, living long is a good thing, but it also magnifies all these risks we have in retirement, like market volatility, rising healthcare costs, and this low interest rate environment that we've been in for such a long time. What are some of the things that a surviving spouse needs to do in the first few years after the passing of their spouse? Well, the first year, they're going to be looking at their wills and trusts, right? And they'll have to start executing them and digging through them and seeing what happened and what needs to happen. If they didn't have a trust, maybe they need to go to probate court, which can be a long and arduous process. Retirement accounts, you'll have to change the distribution options. And so you'll have to elect that and see what makes the most sense. If there's in life insurance policies or even long-term care insurance policies, you need to notify the insurance companies that someone's passed away and make these claims. And we've seen people that have a multitude of insurance policies left over, and they need to claim on each one and sometimes find them. Somebody could be paying on them for years and completely forgot they had them. And then just decide on the Social Security survivorship decision, and we'll go over that. In year 2, that's when you would have lost the joint income taxes, and now you're going to be a single filer, and that changes things drastically, how much taxes you pay. And then year 3, this would be reflected in how much Medicare premium you're paying, because your Medicare premium is directly tied to your income taxes. It's also, year 3 is also the last year where you lose that home sale exclusion. So if you sell your home, you have the first $250,000 in gains is tax-free. As a spouse, you get double that, so you get $500,000. But you would lose that in year 3. And then also long-term care. My grandmother did take care of my grandfather in his final few months, but now who's going to take care of grandma? So luckily she did have a long-term care policy that he got for her. Now she's in an assisted living facility and she's using that. But that's something that needs to be planned for, in the early stages of retirement, in 50s and 60s, not already in her 90s, but luckily that was in place already. So like I said, longevity risk is one of the largest risks in retirement because it magnifies everything else. And women, it's just the way it is, statistically live longer than men. And we always hear many reasons why men think this is so. But on average, women just live longer. So there's a bigger risk for women. And a lot of the time, they're also the ones that have less of those retirement accounts and less of those retirement assets. There's a 50% chance that women are going to live till age 90. So you can see if you retire in your 60s, you're looking at about 30-year time horizon in retirement. And these people are the chances of living longer are going up every year as medical technology improves. And the longer you live, the bigger risk you have to a bear market, right? The market going down a couple of years. The longer you live, the bigger risk you have to healthcare costs. And the longer you live, the bigger risk you have to interest rate fluctuations as well, which can affect your distribution options. One thing that is really not talked about enough, but is really one of the forefronts of retirement planning is withdrawal rate risk. And withdrawal rate risk is saying, I've saved, this bucket of money for retirement. I have, a handful of retirement accounts. How much can I withdraw from these accounts and be relatively certain I will never run out of money without knowing when my last day is, without knowing if I'm going to live till 80, till 85, till 90, till 95, maybe even till 100. We don't know how long we're going to live. So there's something called withdrawal rate risk, which tells us the probability that we will not run out of money during our lives. And over the past several decades, the recommended withdrawal rate has gone down drastically. And one of the reasons for this is interest rates have fallen dramatically, as well as market volatility has increased a lot as well. So withdrawal rates used to be recommended at around 4%. Sometimes they'd say even 5%, but now withdrawal rate recommendations are around 2.5% to 3%. What does that mean? Let's say you have a nest egg of $1 million in different retirement accounts, maybe between you and a spouse. It used to be, they would say, well, 4% of $1 million is $40,000. You can take out $40,000 a year, and you can be relatively certain, we'll say, 95% certain you won't run out of money. Well, now withdrawal rate recommendations, like I said, are closer to 2.5% to 3%. So now they're saying you can only take out $25,000 to $30,000 a year and be relatively certain that you won't run out of money. And there's a lot of strategies to get around this. And this is one of the things that we focus on the most with our clients. But it's important to be aware that even if one spouse says, oh, my health isn't that good, I'm not going to live past whatever it is, 80 or 85, remembering the surviving spouse can outlive them by a decade and a lot of the times even longer. So required minimum distributions are an important factor in this. The reason is because if you have retirement accounts, so IRAs, 401ks, TSPs, 403bs, so these are not Roth accounts, but these are the traditional style accounts. The IRS has basically been waiting your entire life to tax this money. And the way they do that is there's a law that says you have to start taking out money out of these accounts at some point in your life. Now, the law used to be, it was the age of 70, and it changed about a year ago. Now they've pushed it out to age 72. And initially it starts off at a very small percentage. So you can see it's 3.9% at the age of 72, which is not that much. However, it is more than the recommended withdrawal rate to not run out of money. But as you can see, every year it increases after that. And once you get into your 90s, the withdrawal rate's now close to 9 to 10%. And so with such a high withdrawal rate, you can see how you can quickly deplete your money. So RMDs have to be factored into a retirement plan because you have to obey the law. If you don't, they penalize you 50%. But you have to balance it out with also not running out of money. And there are a lot of different strategies we use with clients to balance these two factors, to satisfy R&D, but also take away the risk of running out of money in retirement. So some strategies that need to be considered, pre-retirement, optimally before you retire, right? You want to start thinking of these. But you want to consider survivor benefit options on, for example, pensions. So if you are one of the lucky people to have a pension, before you retire, you'll get a packet and they'll give you all these different options to take. It says you can take, a lump sum, or you can take a life only option or a survivor option. It's very important to spend a bit of time really looking at these options, how they'll impact you, because once you make that election, you can never go back and change your mind. It is set in stone. Also, to consider withdrawing safe and sustainable amounts. So even though you might need more money from your retirement accounts, taking into consideration how that's going to affect yourself, your retirement lifestyle 10 to 20 years from now, considering that inflation is going up, cost of living is going up. And then look at other ways to create guaranteed income. And so this is a lot where our strategies come into play, where we say, let's not play around with luck and statistics. Let's create guarantees so that no longer how long you live, spouse number one, or you live spouse two, you will make sure that you will never run out of money. And this ties into joint life income benefits. So you are making different options, looking at joint life income, not just one person's lifetime, but both persons. And then life insurance. And I quickly want to say about life insurance is, if you have it, it's very important to understand the kind of policy you have. We've met so many people who think they have this life insurance that does one thing for them, and then come to find out it does something completely different than what they thought, and it doesn't actually help a surviving spouse the way they thought. So important to review these early on in life when you first retire. Do not wait until you're several decades into retirement. Now we're going to start. Elsa's going to take it over for, she's going to be talking about healthcare and long-term care costs in retirement. You're on mute, Elsa. Here, I'll unmute you. There you go. Now you're on.
Hi there. Okay. Hi, thanks, Glenelle. So when formulating a strategy to protect a surviving spouse, it's good to know what kind of costs are involved. The second largest expense in retirement is healthcare, looking to spend about $285,000 over the course of retirement for a healthy 65-year-old. And the reason for that is all the out-of-pocket healthcare costs like Part B, D, deductibles, coinsurance, copays, hospital stays, and even dental. My father retired a couple years ago, and he was in for a surprise when he realized that he had to pay for dental treatments out of pocket, and he was due for a root canal. So that's something to consider, is the cost of healthcare. Next slide. Hello, next slide. Glenelle, okay. So Medicare costs, we don't have time today to go over all the different parts of Medicare, but we did do a recording of a webinar called Medicare Made Easy on September 25th. It's on our website. But Medicare costs for a married couple with an AGI, or adjusted gross income, of $174,000 will be looking to pay about $5,000 annually per person. Next slide. So for those of you who are not familiar with long-term care is needed when you can't do 2 out of the 6 activities of daily living. That's eating, bathing, dressing, getting in and out of bed, and toileting. Long-term care does become essential if your surviving spouse or you get Alzheimer's or severe dementia, so any cognitive impairment. What's interesting about this slide is that women need it longer than men by about 1.5 years. So if you're blessed with a long life, even worse. If you walk into a nursing home today, anywhere, 7 out of 10 will be a woman. And finally, there's a myth that Medicare, if you have that little Medicare card, it covers long-term care. But we covered this in the last webinar. It does not cover. It's for a limited stay. It's for up to 100 days. And after 101 days, you or your spouse is responsible going forward. So in addition to monetary costs, there's also the emotional cost or burden on the children to care for their surviving parent. The same thing happened to my mom. I was about 15 years old when my grandfather had severe dementia and had to come and live with us because he could no longer live independently. It was really hard for my mom, who was 39 years old at the time, a young family, full-time job, and having to juggle an aging parent. It eventually became difficult for the family and her siblings to go back and forth. And so they made the tough decision to bring him back to the Philippines, where he could get the 24/7 supervision that he needed. He eventually died a couple of years later due to the quality of care. And of course, it's a third world country and it's in a rural area. But that's one of the reasons I got into the business, was so that no other family had to go through what we did, and they know what options are out there. So it's an important consideration when planning, so you have enough funds to cover a surviving spouse. Next slide. So these figures show the cost of long-term care in Hawaii and over the next 30 years. They are expected to double and almost triple for a semi-private room. We were talking about these figures the other day, and Kelly said, wait a minute, it costs $12,000 for my grandma to get a semi-private room, or home health care rather. And that's because her grandma needed 24-hour care. So it really depends on the skill. So if you need somebody 24/7, it's going to be a lot more expensive. So if the ideal situation is for a spouse to stay out of a nursing home and receive care from the comfort of your home, it makes sense to explore the costs, and makes sense to see whether it's feasible to do it out of pocket with the withdrawal rates Glenelle was talking about, or transfer that risk to an insurance company. So some things to consider when coming up with a protection plan: it's what kind of quality of care do I want my spouse to have? Is my pension and Social Security going to be enough? Who's going to cover the gap? Will the government step in to help? Do I even qualify? And will my assets, other than your primary home, like a second home or money in an investment account, will that be spent down? And will I be able to leave some behind for surviving children? So what can you do to protect your surviving spouse from being a burden on others, and assets from being spent down for long-term care? Again, in-depth coverage, we went over this, and it was like half an hour on the previous webinar called 800-Pound Gorilla, Long-Term Care. And that's also on our website. We don't know, like Glenelle said, if these scenarios are going to happen. You could fall asleep, never wake up, and leave your surviving spouse without the burden of long-term care. But there's a probability that your spouse might need it, and the cost could be enormous, both financially and emotionally. So much better to plan for the worst, hope for the best, and don't leave it to chance and good luck. So that's my part. I'm going to turn it over to Kelly to talk about survivor benefits.
Thank you. I just made Kelly the host.
Unmute.
Okay, hi everybody. Next, we're going to be talking about Social Security. This is a big decision, especially if you're married, because there's different strategies here. So as long as you paid into Social Security, you worked, paid in for 40 quarters, or your spouse has done so, you're eligible for Social Security. And when can you get it? You can either get it at full retirement age, and I'll show you a chart next, based off of when you were born, dictates what year you can get, what age you are, to get your full retirement benefit. You can take it as early as 62, but your benefits will be less depending on when you take it. Or you can delay it up to age 70 and your benefits will be more. Now, this is a big factor for spousal benefits, which we'll get into next. So this chart shows, based off of the year you're born, when you can get your full retirement benefit. So for Glenelle, Elsa, and I, we will be able to get our full benefit at age 67. We can still take it as early as 62, but we'll be penalized. So this chart's here. So as I mentioned, your benefits are based off of your work. And so what they do is they average out 30 years of your income. And so let's say you work for 10 years and then you didn't work, raise the kids. They'll count those next 20 years as zero as far as their calculation to figure out how much you'll get for Social Security. Or, so they'll give you the higher of off of your record or off of your spouse's record. So if you're married, you can get up to half of your spouse's benefit. So if your spouse's benefit amount is $2,000, you'll be eligible to get $1,000. So let's say your own benefit amount is $800. Well, since half of your spouse's one of $1,000 is more, you can get that one. You cannot, Social Security has changed the rules a lot because they're running out of funding. And so now, as it is, you cannot claim spousal benefit until your spouse files for benefit. You might have heard like file and suspend and all those things, but it's very rare now because they're being phased out. So this is a big one, survivor benefit. If your spouse passes away, you can now get the higher of your benefit or your spouse's benefit. So this is important because let's say, going back to the earlier slide I showed, let's say your spouse takes Social Security early at 62 and gets a lesser amount of, let's say, $1,200. Well, that amount is going to be forever. So even when spouse reaches full retirement age or 70, it's still going to be that same lower amount forever. Let's say that's husband, and husband passes away, wife will then get that $1,200 forever, that low amount forever. Versus, let's say husband waited until 70, and now that amount, let's just say, is $2,000, and then husband passes away, wife will then get that $2,000 forever. So especially if the higher income earner hires the person who's getting the higher Social Security amount, that's going to really have a big benefit on the survivor benefit, right? Because the higher one carries forward. Along with that, so survivor benefit, you can actually, surviving spouse can actually take that benefit as early as age 60, but of course benefit will be reduced up to 28.5%. And there's some exceptions for widowers and children under 19. And so one strategy is, let's say surviving spouse, they don't really need the money and their Social Security benefit's going to be pretty good. It's going to be more when they retire. But what they can do is, since they have it available, they can take their survivor benefit at 60 at the lesser amount. It's just extra money. And then once they reach full retirement age or 70, switch over to their own and get that higher amount for the rest of their life, or vice versa. So different things you can do here to at least maximize the benefits. And again, it's all individual situations. So if you have any questions, we're happy to talk to you offline. So as I mentioned, especially with spouses, you might want to consider if it makes sense to delay Social Security benefits for that survivor benefit, just to maximize it, depending on life expectancy, health, other income factors. And for many of us, Social Security is not going to be enough to live off of. I mean, the high cost of living in Hawaii. So you might also want to consider supplementing that income with other sources of guaranteed income. Okay, I wanted to touch upon this because this is kind of a big shocker to people. Medicare premium is based off of your income. And what they do is they look at 2 years ago to figure out what you pay now. So this chart shows if your income was this in 2018, this is what you'll pay in 2020. For those who just retired, you can file an exception saying, hey, I just retired. Please look at my retired income rather than my higher earned income when I was working. So let's look at an example. Let's say you and your spouse, sorry, okay. Let's say you and your spouse have 120,000 of income in retirement. And so you'll fall in this category here circled. And so you will pay $144.60 each for Medicare. Not bad. But now let's say one spouse passes away, but income is going to be relatively the same. I mean, Social Security, one is going to drop off, but the rest of the income is going to continue. Well, now your 120 of income will put you in this category here by this arrow. And so now your Medicare premium jumps up from $144.60 a month to $289.20 a month. So shifting from the joint to individual also affects how much you'll be paying in premiums. So not necessarily when spouse passes away, half the expenses are gone. Not necessarily here. So things you can do now to reduce your modified adjusted gross income for the future so that that type of thing doesn't happen to you. Some things you can do is open a Roth IRA or convert to a Roth IRA. So that's where you pay the taxes now in essence, but later when you withdraw that money, it comes out tax-free. For spouses who are still working, you could possibly at that time contribute to 401ks or IRAs to reduce income. Also, you can consider tax-efficient mutual funds or municipal bonds that are not taxable. Look into health savings accounts. Certain annuities can come out tax-favored. Even life insurance, if structured correctly, you could use that as a retirement savings vehicle. And then when you take it out, structured correctly, can come out tax-free, which will not affect your Medicare premiums. Now, just like that Medicare table, the federal income tax bracket is something to look at too. So let's say you're married, filing joint, income is $75,000. So you would fall in this here, 12% tax bracket, married, filing jointly. So up to your first $19,750 is taxed at 12, and then the remaining is taxed at 12%. Let's say one spouse passes away. Now you're going to be filing as an individual. And let's say your income maybe from $75,000 is now $60,000. Still, you're going to be pushed up into this bracket, which pushes you up into the 22% tax bracket, 10% increase. So keep that in mind also when planning for retirement. Expenses can go up, not just, the cost of goods, services, but also taxes could go up potentially. So besides thinking about the financial things, we need to consider the healthcare, right? As Elsa talked about, long-term care is a huge cost. And when thinking about long-term care, it's not just, okay, let's say long-term care is $15,000. I'll have that money available. It's also thinking about that spouse. When my grandma needed care, she wanted to stay home because that's where she was comfortable. And it was good because my grandpa, they could see each other all the time. Her care was $12,000 a month, but we can't forget my grandpa. He still had to maintain the household, pay the property tax, electricity, all of that. So that we have to take into consideration long-term care money still cannot be taken out from the regular living expenses. And then again, really important to look at other sources of income you can create now to cover healthcare costs, because they'll get very expensive, not just long-term care, but as Elsa talked about, the deductibles, the co-pays, other things that come up. I mean, my grandpa, I think he's on his third set of hearing aids, just because some of them are not good and insurance doesn't cover it, so he has to get a new one. And just small things that happen along the way, if he gets a cut, unfortunately turns into an infection, and he's just going to the doctors a lot more. So in summary, retirement income is decreasing, unfortunately, with less pensions, less resources. Retirement liabilities are increasing, also because we're living so much longer. When Social Security was first enacted, the average life expectancy was 63, and Social Security started at 65, so hardly anybody drew on it. But now life expectancy is in the 80s, right? And so now we actually have to really plan for our retirement and make sure we have enough money to last our lifetime. So it is really becoming a lot more challenging to have a secure retirement. And especially widows and widowers, particularly are vulnerable to outliving their retirement income, just because not two people that could potentially live a long time. So if this is a concern for you and you want to dive deeper in your situation, please reach out to us. Our information is here. We all work together. Be happy to help you. Also, you can check out our website. We also have a wealth of information there.
Kelly, can you make me the host again? I just want to share.
Yes.
We had a lot of people come on later, so I just want to share something.
Sure. There you go. You're the host.
Okay. So every month, again, we do webinars, and to find out about them and to register, you can go to our website. Again, it's summitfinancialhawaii.com. So it'll take you to this homepage. If you go to workshops, click on that, you'll see our upcoming events. So our next one is December 8th, which is a Tuesday, same time, 11:30 to 12:15. They're short, they're only 45 minutes to keep them interesting. And so we usually target our webinars for people that are approaching retirement, but this was end of the year and we know kids are home for the holidays, so we wanted to do something for the younger generation. So it's what you should be doing in your 20s and 30s, tax saving tips and investing. And so if you want to attend this one, register now because the Zoom info will be sent to you now. Registration does close when the event starts. And then if you have anybody in this generation that you think should listen to this, please send this to them and tell them to register. We'll be talking a lot about IRAs, 401ks, like what is a stock and a bond, mutual funds, just a lot of basic stuff like that is really good information, and why it's so important to start early. Also, our YouTube link is up here as well. So if you click on that button there, that'll take you to our YouTube page where we have our previously recorded webinars as well. And at the end of this event today, Zoom will ask you a couple questions, like what other topics. We're always looking for ideas for new topics. And we have some interesting ones scheduled for the beginning of next year already, but we're always looking for new topics. So if there's something you really want to know about, answer the poll question when I end this meeting, and tell us what you want to learn about. And we'll try to get it scheduled in our calendar for next year. And then if you want to set up a private meeting with one of us to talk about something we talked about here, something else, please let us know when a good time to be would do that. And we're very virtual. We're doing almost everything via Zoom these days. I don't have anything else. We're a little bit early today. Nobody asked any questions I saw. But as always, any questions you have, please reach out to us. Whenever I'll put our, you have our contact information came off already. You can always reach us at info@summitfinancialhawaii.com. Okay, anything else, Kelly?
You covered everything. Thank you, everybody. Stay safe and see you next month.
Aloha. See you next month.